annual Africa CEO Forum.
L'Africa CEO Forum.
Africa CEO Forum.
Le Davos africain.
Biggest event of its kind on the continent.
Si nous arrivons à faire du beurre et de la pâte de cacao, nous pouvons créer un genre d'OPEP chocolatier.
Really so surprised and excited to see so many people from all over Africa.
This is the place to be if you want to meet all the relevant people that count, that drive Africa's growth.
Good morning, good evening, good afternoon, wherever you're joining us from. Welcome to this edition of, I think it's the very first webinar of the year from the African Financial Industry Summit. Thank you for making the time, for giving us your attention for the next hour and a bit as we examine this novel topic for today, alternative credit scoring in Africa. Do we have new tools, new tech, new hope perhaps to expand financial inclusion across the entire continent? That is going to be our focus for the webinar today. We're hoping to get a lot of your content, a lot of your input, a lot of your attention and your questions later on, of course, in the program. If you're watching this on Zoom, you can certainly do that down below. I believe that will be in the Q&A segment of the conversation. You can fire off questions to our speakers. The Q&A section on your Zoom platform essentially is where you should drop off those questions. We will see them, we'll pass them on to the panel in just a moment. That's essentially what we're going to be focusing on in just a bit. But first, let's get back to the topic, alternative credit scoring. Lots of fintechs, lots of commercial banks, lots of insurers right across the continent. They're increasingly deploying a lot more novel tech, a lot more algorithms, a lot more AI is being deployed, a lot more machine learning is being used to expand access to credit. The days when you'd have to go to your bank in order to get access to a $10,000 loan, a $5,000 loan, essentially those are gone. Today you can get access to that sort of credit without actually having to talk to another person. But can we do better? We'll be exploring that in three main perspectives in just a moment. But first, to set the stage for our discussion, I'd like to bring in Riyad Noor. He's the manager of FIG Advisory Services covering Africa at the International Finance Corporation. Riyad, over to you.
Thank you, Rama. Hi, everybody. And thank you for having me, Rama. Look, I'm delighted today to share with you a short presentation on the topic, which is the alternative credit scoring in Africa, a new hope for financial inclusion. And we can see from this slide, we are all aware, I believe, about the importance impact of the development of mobile money on the financial inclusion agenda in Africa. Just to share some numbers, from 2014 to 2017, the financial inclusion doubled in Africa from 22 to 42% thanks to the mobile money development. And from 2017 to 2022, we can see the same trend, an increase, and we can share some data. In East Africa, we can find an average financial inclusion of 55%. So, and we can see from this slide that this is how I believe the users, the end users, our population, they are using the mobile money. Its majority is using it to send money or to receive money. And we can see on the top of the graph that there is still room to enhance what we call receive payment, which is all about the commercial transaction. So we did well for the last few years, and there is still, I think, a lot to be done for a better utilization of all these nice impact brought by the mobile money into the financial sector space. It's all about how we can better use the data to formalize the informers, to score the unscorable, and to bank the unbankable. And all of this is based on financial players terminology. I remember a few years ago, we did a very insightful assessment in Uganda, for example, where we realized that within the mobile money platforms, 30% of the transaction was led by SMEs to buy, to sell, to pay salaries. So we are in a space where a big part of the economy, it's boiling, it's moving there. And that's how we can move to the next slide, please. So we can see that the gap, because it's not only about helping the people to access to a mobile money account or a banking account. Now that was, I think, on its way to reach a high level of financial inclusion, like we can see in Kenya, 83%. I think now how we can improve the utilization of these platforms to go vertically, to provide better services, to improve the lending. And you can see that the MSME financing represents a gap of $331 billion in Africa. And when we talk about MSMEs, we talk about women, we talk about farmers in the agriculture sectors. And all of this is because of the lack of credit history and low collateral ownership. So how we can fix this, how we can tackle this through alternative data. And we can see, in the graph from the link between the lenders, the financial service providers, and the real sectors and the middle, how we can provide more data. Now we can find data within the supply chain finance, within the value chain. There is new tools that we can talk about it more later, like the psychometric scoring. And all of this needs to be unlocked. Unlock the barrier for financial institution to reach more SMEs. I would love to share with you a number in Egypt when they automated the collateral registry in 2018. Now we can see an increase of $105 billion in lending for the SMEs, thanks only to the implementation of more agile collateral registry for movable assets. Next, please. So when we talk about alternative scoring, it's a wide space. We can see on the left side of my presentation a graph where we can see the business registries, the credit registries. We can talk about credit bureau. There's the public, there's the private, the public credit registry, there's the private credit bureaus, and it's really quietly and nicely developed in Africa for the last, let's say, for the last 10 years. I remember in a previous mandate, I led the implementation of the credit bureau project in partnership with the BCAO, the WAMU central bank covering 8 countries, that led today to multiply the lending by 5, at least for individuals. So we can see the impact of the importance of all of these tools, the credit scoring. We can talk about, like I talk about the alternative scoring, the partnerships between the data providers, the mobile money providers, and the financial institution. For example, currently we are working with a mobile money operator in Mozambique, where we were able together to increase the access to more than 5 million people in Mozambique to financial services. And now we are opening a large partnership between the mobile money players and a financial institution, the second largest one in the country, to increase the lending. And I remember also in Madagascar for the last 12 months, this is a recent project where we were able, by the introduction of psychometric alternative data scoring, to enable 1 million nano lending with a microfinance institution in Madagascar. So all of this is a reality. We can see all the players, the lending investment players, the non-bank financial institution, the banks, the mobile money operators, the payment company, the credit institution, and how the middle, they can serve the real sectors and mainly the unbanked people. And we can see on the right side, the tools. So now we are talking about artificial intelligence. We are talking about engines to better assess the risk, to accelerate also the assessment about the risk. Time matters. When you take the agriculture sector, in the agriculture sectors, it's important to access to lending, but time is key. If I need the money in February to start let's say my rice pre-harvest season, if I get the money in April, it's too late. So the risk management engine, it's very important, and then the limit allocation of pricing, all of these are new tools. They are available in our continent, but how we leverage them. Regarding privacy, it's number one to ensure that the regulatory bodies play their role. And in many, many countries in Africa, I think in the majority of our countries in Africa, they have already implemented a data privacy law that I believe the majority of them good enough to protect the rights of data privacy for all of us. And the mitigation, like I said, it's a strong regulation, it's the consent, data security, and regular audits to ensure that whoever is regulated or licensed to provide data, they have the right governance and the right security to protect the data. Other challenge in access data and verification are what we call the alternative scholars models, which rely on unconventional data. So there is the data that we can collect from telecoms, from large vendors like, let's say, electrical companies or public water companies. There is different sources of data. And I think this is what we call the non-conventionals. It needs to ensure that it has a data quality control, it's cross-referencing data and third-party verification all the time. And that's why we can land in the slide that I can share with you, but you cannot see it. We need to talk about the policymakers and why the policymakers need to adjust the regulatory framework to the expanding data economy. We saw in many countries the agility in Kenya, in Uganda, in Tanzania, in Ghana, in Morocco, in Egypt, everywhere in Africa, in Nigeria, in West Africa, how the central banks develop some agility and create an environment where mobile money players and tech players within the financial space were able to test. And then based on the proof of concept, regulation came later to support. And I think we did well on adopting mobile money, and I'm sure that the same policymaker now that are more open to innovation, they will do also well on adjusting regulatory framework to expanding data economy. We know that innovation in the expanding data economy can have a huge effect on inclusion and efficiency, but there may be trades-off, and we can see that reviewing the market power of big techs and other holders of significant data, social media and others, assessing the way they use this data and control access to compete in other fields, including financial services, issue of reciprocal access being raised. So I'm sure that, like I said, as we trust our policymakers to evolve and to follow all of this space of data. And like I said, I will close my presentation by the last slide, which is, I believe, if we can move there, we can see the spectrum. This is where we are, and this is why I think it's not it's a relevant topic, but not an easy one. Following the success of mobile money, the future of alternative data scoring in Africa is to further support access to credit. Now, like I said at the beginning, now that we have access to financial services, sending money or receiving money, it's not enough. I think our population expect more. We can talk about agri and how the agri-finance can help us to fix the food security. We can talk about health and how the insurtech can help us access to better health services, to better ensure and how we can bring the vulnerable to that space. And you can see in the blue bubbles that we are talking about social media, fintech, transaction, market position, product profile, agri profile, technology enablement, growth, security, risks. So all of these is the nice new space for data. And that's, I believe, what our brilliant panelists today will discuss. Thank you, Rama, again, and over to you.
Merci, Riyad. That actually does set the stage fairly well for the conversation we're about to have. So let me start by introducing my panelists. We've got a fantastic panel lined up for you. Individuals who are not just talking about this in theoretical terms, they're either lending money out, so they have to do this and manage risk on a daily basis, but at the same time, they're also building the systems that we need to better assess credit risk and expand financial inclusion. They include Dr. Jamila Sharif Aydoun, she's the Senior Managing Director of the Credit Registry. We have Yunus Rogoro Gatama, Director covering Africa at YABX. Joining us from Uganda, I believe we're the second largest coffee producer on the continent. It's a lovely, lovely country. Acting Chief Product Officer, MTN Mobile Money over in Uganda. And at the same time, we have Omar Balafrej, Head of Business Development at the Bank of Africa, joining us, I believe, from Casablanca?
Yes, currently in Casablanca, but most of the time all over the continent.
All right, then. So there you go. We basically have most of Africa covered, from the south, the west, the east, and the north. We're all here to have this conversation in a bit more detail. I just want to pick up on something that Riyad mentioned in his presentation. I'm going to start with you, Jamila. Data, it's important. There's a lot of it out there, but what is useful and what isn't useful?
Thank you very much, Rama. This is certainly a topic that resonates well with us as a credit bureau, right? And we're a credit bureau in Nigeria. One thing I do want to make sure that we all are setting the stage when it comes to scoring and what that really means. Scoring is really just a predictor. Right, it's a way where we're saying that, hey, we're taking the past behavior and predicting, future behavior with it. And when we look at all this different data comes in so many different ways. In fact, data is where the complexity lies. And when we think about that and the complexity that comes with it, if we were to take just you, Rama, if you were a bank in itself, right? You have, let's just say here on the panel, everybody's bringing you a different point of view, a different point of data. That's where the complexity would lie. So let's say we have Dennis is going to bring you mobile data. I'm just looking at our different panel here. Omar, let's just say, for example, he's going to bring you tarot cards. Data is everywhere. Who's to say that what data is good until you see it, right? You also have, of course, here Eunice. Eunice might bring you affordability data. All this data is where the complexity lies. And as a bureau, when we think about it, that's where our job starts, is to take all of these different data sources and be able to understand and determine what is actually the data that's going to predict a good credit risk. And so when you start thinking of alternative data and using it for lending, it's about what's going to predict a good credit risk. You can use alternative data for various things. You can predict sales. You talked about online social media. So you can have a sales prediction. But when we're talking about credit data, it's very important that you looked at predictors that are using data that's going to be relevant. You want to use data that's going to have a customer behavior predictability to it. You also want it to be stable data that you can get, consistently. For example, inflation is going up and down, right? So that wouldn't be a good indicator of the type of data that you want to use to predict, right? You want to make sure that the data is always available. You're getting new forms of that data consistently over time. And so when you start thinking about all of these different data sources, it's not about getting a one-time dump. It's not about taking, alternative data and using that in a way whereby it could bring more risk to it. So when I think about this overall, we want to say complexity of all this data coming in needs to be simplified. And so when you talk about replacing, if you will, credit scores, this is a very dangerous concept because essentially that's where all of this data should come together and be able to be simplified so it can be used to minimize that risk that a lender now needs to take.
We're not replacing credit scores as we know them today. We're simply making them better.
Exactly. And so lenders utilizing, those forms of data that's coming in from the bureau or from a credit score is because it's taken into account all of these various data sources and determining what's actually going to predict, minimizing risk when it comes to lending.
All right. So I'm going to put this to all the panelists in turn. Can you walk us through one novel data set, one novel metric that you've come across, that you've experimented with, that would fall into this category of, alternative data sets? To give our audience an example, I've spoken to some in the digital lending space here in Kenya, and one of the interesting things that was mentioned initially was, there's an element of correlation between the way in which people save names in their mobile phone contacts. If you capitalize the names, if you have proper names right there, instead of just saying mom, for example, you actually have like a full name there. That those individuals tend to be better at paying back the loans that they have taken, which is a little interesting to think about and completely unexpected. But Jamila, is there any interesting novel metrics that you're coming across in Nigeria that has potential?
Right. I think one of the things that we realize is that lenders are taking a different approach at all of this, right? And it actually, we worry about it. I'm going to be very brutal here in that, looking at alternative data and making a lot of these predictions without the historical proof of it can actually, we're thinking of it as potentially a silver bullet or a holy grail, but really it could be a perfect storm as well, right? And so when we are looking at alternative data, it does take time to review that over a period in order to be able to determine if it is the best predictor when we're talking about credit risk. And I want to be very clear about, it's like credit, we also think of credit and medical as the same. You don't want to make a mistake, right? When you're talking about sales or predicting profit or predicting revenue or predicting the next best offer, you can make mistakes there. But when you're talking about credit or medical, you want to be very, very careful. And so, if I knew that social media was going to be a determining factor of my credit, I'm going to start pruning my list of contacts, right? I don't want everybody on my social media. So as my friend, so you really want to be careful. And that's where that complexity needs to be simplified through behavior of the consumers across a period of time. And that's where I say alternative data needs to be very careful when we come to that. It's really just, I'm going to say, a piece of the pie. There's this idiom that says that, how does it go? It's like the whole is greater than the sum of its parts, right? And so alternative data is just one part of this ecosystem of data. And so all that data needs to be put together in order to make the best predictive decision when it comes to credit.
All right, Eunice, let's bring you in here. In your work at YBX, what novel metrics are you seeing? What's interesting? What are you experimenting with?
Yeah, I think critical for us at YBX is we look to partner with sources of data that we can then use to enrich our credit scoring models, primarily to be able to predict income proxy, because when you're looking to offer digital credit, you must be able to range and say, to what extent of a limit can I advance to this individual as we start this relationship? So, of course, key for us has always been telco data with partners like MTN, Airtel, Orange, and other telcos across Africa and across the globe. So we then see behaviors like how many times is this individual receiving money from other people in a day? So I give an example of individuals who are running businesses, but they're not formal enough to be able to, for example, have a merchant till or a point of sale machine at their workplace. So you find such an individual receives a lot of person-to-person transfers coming in through their mobile wallet. So we are able to translate that to a business income proxy. So in that case, you can profile that customer for not just a personal loan, but take it a level higher and be able to offer them a merchant proposition together with, for example, MTN, and say to this person, upgrade yourself and get onto the merchant product and get a merchant loan on top of that. So predictors around just frequency of payments is able to tell you in terms of inflows and outflows, what is the income level of this person? To what extent should I lend to them? And following that over a period of time, you can then begin to increase their limits because you start to see more and more transactions coming in through that particular channel. So payments has been big. for us in terms of person to person, or even just how are you paying your utility bills, how are you paying for fuel. You find it interesting, like in Kenya, the more somebody pays into a betting pay bill account, then the probability of them repaying your loan on time drops drastically from a sample that we analyze. So you start to see those behaviors just by looking at proxies on payments.
Dennis, in your work in Uganda, because you essentially are sitting on the telco side of the equation, right? So you have got tens of millions of clients who are using mobile money services. They're generating all this data, but are there any interesting novel insights that you've picked up along the way that would essentially make it into a credit scoring model?
Yes, very interesting, I think, submissions by the doctor and Eunice there. I think just to add to what they said, in light of building the creditworthiness of any customer you want to serve, it's basically you're building a certain level of trust, that's built on certain levels of tiers of how much you can sort of award in terms of credit, to a point where it does add value to the customer, but also it's not driving you into the red. So yes, the more you know about your market, the people that we serve, the better it is to build a much more stronger credit score for each customer. So we do have some basic information based on the industry that we work in as MTN. We do have millions of customers who use our platform, but of course there are certain aspects about a customer that you do not have any visibility on, like the sources of their funds and the frequency of those funds. So that's where we sort of have to rely on other data that may not necessarily be entering our ecosystem or our sphere of operation. I'll give you an example. So in Uganda, culturally, we have women do a lot of savings, the women in our country. Many of them deal with agricultural and small entrepreneurship ventures, but they are very heavily cash driven in terms of how they collect their monies, how they save, and how they make payments. Now, along the way, over the last few years, we've had sort of these small savings schemes that they call Kabox. Kabox is sort of a colloquial term to mean a box. Basically, you have a savings box that you put your money into as a collective. Somebody has the key to that box and has to keep it safe. And everyone puts their savings in there, and then that is used for some other investment opportunity that comes along as a group. Now, all of that is happening outside any kind of digital platform or mobile money ecosystem. What we've had is partners who have gone out to seek out these small groups and try and digitize their operation and provide them a wallet, a digital wallet where they can all submit their money through mobile money. It provides a safer, more convenient channel for them to operate their
and all group
savings
members, I presume, would have visibility into money coming in and going out.
Correct. So those are the benefits that they offer. Now, with that sort of setup, you're able to now see how frequently and how often they get their finances in, how often they're saving, how often they're receiving money, which becomes a sort of novel metric for you to use if you want to offer them credit services as well. And it's information you didn't have before. So yes, I think to your question, we do see a lot of novel point metrics that we could use, largely driven through strategic partnerships where people can go where we can't, where the telco can't, where the finco can't go. But you find that others have other strengths in that field to go and look out for these business opportunities or these opportunities for us to kind of feed more data sets into the credit rating policy that we may want to run.
Does that extend into partnerships with utilities like Umeme, for example? Remember, for the benefit of our viewers, is the utility in the electricity utility.
Yeah, electricity. Yes, absolutely. All utility companies, all entities that are able to receive payments through our system, then provide a data source for us to use to credit score.
All right, I'll get back to the partnership element of that a little later. But Omar, I want to come to you on this exact same question, but I want to modify it slightly. and I say this, bringing a certain amount of bias into the equation. And here's a bias that I'm going to declare here. In East Africa, at least in Kenya in particular, we've been very heavy on using mobile money. It's almost become the norm, right, for us here. I barely carry cash on a daily basis. But in contrast, you've got a country like Nigeria, right, very, very heavy on cash. Virtually all transactions, you're going to pay for your fuel, you're paying for public transport, you're doing this in cash. So in economies around Central Africa, West Africa, moving up into the north, how then do we build novel metrics in societies where things are very cash heavy, right? So these transactions don't have an electronic backup on them. So how do we build those data sets?
Thank you. Yeah. First, I would say that things are changing. If we take West Africa, it's more cash is there's less and less cash and more the usage of wallets. Take West Africa, wallets are booming for the last 2 years, and it's impressive how fast they're going, and maybe they will reach the state of East Africa in the coming years. You can see in a country like Senegal how some new entrants have really performed very, very quickly, but with bringing some value added to the final user. So my first thing is that I would say that for alternative scoring for individuals, the use of the wallets are still key. It was mentioned earlier, but one of the best way of scoring a person that use a wallet for lending that person some money is to see his or her behavior on the wallet itself, in terms of cash transaction, what kind of thing he pays, what kind of thing, how many times he put money on his wallet and withdraw that money. So that gives information that could be analyzed by specialists. And us as a bank who's present in 18 countries, we consider this actually the alternative scoring as something quite new for us. We're modest about it, and we don't hesitate to go and partner with some fintech that have the speciality and the models to identify and evaluate these kind of things. Okay. So basically, we've seen a lot of fintechs working for individuals, at least in East African countries, but also in Nigeria, in Ghana, and I will mention one of them, which is our partner. It's called Simbrella. It's an international fintech that has actually a good experience in scoring individuals on their behavior on wallets. That's very important, and their behavior on wallets, not on social medias, is just how they behaved in how they use their wallet, what kind of transaction they did, those person, and they could come with a score. And we are currently in the launching process of a project with them, with a telco company in Burkina Faso. It's not yet launched, but it should be launched I hope in the coming weeks, as a first pilot for us in the consumer loans market. We're talking about the consumer loans market. The second market, which is maybe even more important for us as a group, is on the SME market, because we are a group that consider that we should do much more on SMEs in the coming years. It's part of our strategic plan. And here we also need partners that know how to score or to do alternative scoring for SMEs, depending on the sector. I will take one example where we partner with IFC. It's in Senegal. We just did a partnership on the agri-business sector, where we have a fintech, an agri-tech and fintech that basically provide a kind of scoring of cooperatives or small businesses in the agri industry. This kind of customer that we couldn't actually evaluate us as a bank. We didn't have the tools to evaluate the risk on this kind of customers. So we needed, and clearly there's a value added here by a fintech or an agri-tech that knows how to evaluate this kind of customers. Because when we talk about alternative scoring, it's alternative source of information. This is the key thing, is how to provide to the financial institution, the bank here, some information that they don't have they don't used to get. And for this example in Senegal, it's with a company, a startup called Manobi Africa. It's a fintech that has experience on small businesses in the agri industry, and especially in the rice industry, and know how to evaluate how serious are the agricultures or are the SME with their behavior in the last years, and they can provide you with this kind of information. So for us as a financial institution, it makes us confident to lend money to that SME.
So essentially, if you don't have the in-house expertise, find someone who understands the market, get out there and work with them.
That's our strategy as Bank of Africa.
All right, Eunice and Dennis, this question goes to you, and it builds on something that Dennis you mentioned a little earlier. The question around how do we build these partnerships out? How do we build these relationships between the firms that hold the mobile wallets and other entities that might rely on them, utilities, banks, etc. How then do we build an open ecosystem where these algorithms that we're using for scoring are accessible to both parties without one side feeling perhaps this is being a bit exploitative? Eunice, let me start with you.
Yeah, I think that's the space we've been in over the last couple of years, trying to launch and partner with telcos and banks. So what we do primarily is collaborative lending as we take it to market. So we'll go out, for example, into Uganda and find, for example, Airtel in Uganda, and then we'll seek out a bank and together be able to show to them the value of partnering with Airtel to be able then to present a product to the end user, to the customer. Critical is for all partners to be able to see the value they are bringing into the table and the value the other partners are bringing onto the table. I think a lot of the times initially when this digital lending with telco partnership started is that everybody wants to own the customer. So we must be able to say we want to give the customer a solution as opposed to own the customer. From a bank's perspective, they'll be expected by the central bank in that respective country to be able to show that they have secured and know the customer that they are engaging to advance credit to them. That doesn't mean that that is an exclusively owned customer by the bank, because then you're using the mobile money channel to acquire the customer, to get alternative data, to be able to understand this customer away from the banking ecosystem, because like Riyadh said, majority of these are unbanked individuals. So critical in terms of partnerships is for everybody to see the value that is being added by every partner in the ecosystem. If you then plug in a credit reference bureau, these are probably people who've already engaged with credit reference bureaus in a mature market like in Kenya or in Tanzania. Even the digital lenders are starting to push both positive and negative credit information back to the bureaus. You're then able to solidify that and have a central point where you're then pulling information that is relevant, because then you now have history beyond just the mobile wallet that this customer already has in terms of engagement. Are they using credit cards in other institutions that are there, and what's the history of that? So I think primary when we then say partnerships is to all lay our guard down and just think about the customer at the end without everybody building a wall around the data is mine and therefore I am the king of this relationship. And then it breaks down to, okay, go and do what you think you can do. And then people start to try and build expertise that they do not have. And therefore, you're then spending time that somebody else is more specialized in. So I guess it's just looking at the scenarios like Uber. Uber didn't create taxi business or create a customer. They just went and served a need that had been unserved. They appreciated that there are drivers in the market already, that there are customers who need a service, and therefore then just created a platform, and then everybody benefits from that in a central manner. So I think for me that has been critical from a partnerships perspective.
Dennis, how does this work on your end? Because in your telco, you've got on one hand, if you're having this conversation in 2008, you'd just be dealing with the communications regulator, but now it's comms regulator, central bank, in some markets, a data regulator. So how do you manage these partnerships?
Yeah, it's a new challenge. I guess, and also a new opportunity for us, the telcos. Like you said, I mean, we've started off with one regulator, and as it stands now, we have about 4 regulators, including the central bank. As a listed company, you definitely have capital markets and also some of these micro lending regulators that manage more smaller segments of the finance sector. But that aside, I think I just wanted to add to what Eunice was talking about. That old adage of, if you want to go far, you have to go with others. You can't go alone, right? If you go alone, you go fast. But if you go with others, you go far. And it's very much the same for our industry. There are certain capabilities that we definitely bring to the table, that a partner, say like Yabex, would bring to the table, and of course a traditional financial institution would bring to the table for us to actually get the full benefit of having a consolidated sort of credit scoring platform that serves the customer with proper value and not just out to try and make a quick buck. So I'll give you an example. The telcos like ourselves, MTN Mobile Money, we're not licensed to lend money to customers. So we can't do that on our own. We can't go at it at our own. Yabex may not necessarily be, as an example, licensed to lend out money on its own, but the banks are, right? And Yabex, in this case, in this scenario, would be a company that brings with it a skill set of credit scoring, very vibrant credit scoring, experience in the field of actually sort of classifying customers based on their credit risk. And then MTN, in this case, would have the data set that Yabex would need to try and rebuild and improve on that credit scoring model. And then you have the bank on the other end that is providing the funds that will be able to supply these credit needs for the customers that have been scored. Now, all of that is built on a partnership. You can't do it alone. So it's important that, I think, like Eunice said, yes, there is certain elements of who owns the customer. That has been something that I think most of the industries have had to sort of come to grips with and self-define. At certain points, we do have to come together and play. But of course, you have to, at the back end, you have to be very cognizant of your regulatory requirements. I think probably we'll get into that when it comes to customer data protection and privacy, because customers do use your service, and as part of the terms of the service, you are supposed to uphold a certain level of protection of whatever they provide you through using your product. So yeah, I think to that, partnerships are the key in terms of having to build a more stronger credit scoring system. But of course, that has to be within the realms of proper governance.
All right, and I'm sure we'll get back to that question in just a bit, but you've essentially taken us to the next part of the conversation: data privacy and confidentiality. And Jamila, I know this is something you're particularly focused on. When consumers are generating this much data on virtually everything, who are we paying? How often are we paying them? If you look at my mobile data payments, you can probably have a rough idea of where I live, where I work, where I frequent. So what sort of rules of the road do we need to put in place to protect data confidentiality for clients?
Right. And even if we kind of just go back to what this whole topic is about financial inclusion, right? And we're trying to bring people into the system whereby that information about them, we can use it in order to make better decisions. So, but financial inclusion is really only honorable if it's good for the customer, right? If it's good for the customer, that means that the credit has to be affordable for them. And we know that not all money is good money. And so when we start thinking about usury and the cost of if you will, credit and getting access to credit, if it's very expensive, then it's very difficult for those consumers to not only trust the institutions, but even want to use them. So some of the ideas I think that can maybe kind of like allow for us to achieve what we're trying to achieve, which is to get more people to come into an ecosystem and get them financially included so that the economies of our countries can grow. And so when we think about that, then the customer is really the boss, right? It's their data, it's who they are, and it requires for them to give us access to it. It also should require for them to give consent for businesses to want to use that information. And I think that there's this quote that Sam Wilton, he's the founder of Walmart, says best, right? So there's only one boss, and it's the customer, right? He can fire everyone in the company from the chairman down simply by spending his money elsewhere, right? So if we are going to use customers' information, we should be able to get consent from them, and we should be able to use that information in a manner that is going to be beneficial to them. And I'm going to use one example of a client of ours that I believe has done a really good job when it comes to using the information to help their customers. And I believe this is an answer that we all can probably take away with, is not just trying to pull people in and give them access to credit, but actually providing products that are relevant to them. By providing better products, we're going to attract the right type of customer for the right type of product. And so a good customer that I'm really happy to talk about, I'm just going to put their name out there, Secluded, and it's a female-focused funding. It allows for females who are starting their businesses to be able to get access to funds. But they don't only provide access to funds, they provide access to education when it comes to finance. They provide access to insurance, not only for their businesses, but also for their health and their families. They also help introduce females to doing investments. And so they're really looking at the whole of the customer in order to bring them into their business. And we have seen them grow considerably over the last 4 years. They now have, if you will, this custom, or should I say community of over 20,000 women, and they're making these products relevant to them. This is the key to me when it comes to financial inclusion, creating the right product for the customer to get them in the door. Once they're a part of that ecosystem, then you have the partners like your bureaus and other, should I say, industries that you can partner with, because the customer exists. They have an identity, they have a history, and they're able to now continue to grow with further and further access to credit. So let's find the right products for the customers.
Can I just dive in just a little bit, building on what you've said, onto the question of building trust? Because I guess for a lot of customers, especially in our frontier markets, would say, hang on, I've dealt with credit registry, credit bureaus before, and as far as I know, it's always, the negative side of bureaus that we know about. It's this blacklisting tool that has been used in the past to essentially lock people out of credit markets. And that certainly has been the experience, at least here in East Africa, for the last 10 years. So how then do we rebuild that trust? How do we get to a point where, for clients who are saying, yes, we're going to protect your data, but we're not just trying to entice you into the system because we need the data. We're trying to essentially get you in here because this actually makes sense for you. It has positive outcomes.
I love that question. And that's actually why we started Credit Registry, because it is a repentant system. It is not meant to be called out as a blacklist. So part of the process of getting people into the system is to afford them to get better services. And so we say that our lenders and our clients should create VIP lists, right? We should say that if you're a customer and you've been performing well, let's give you better access to credit. I believe our insurance industries do a much better job when it comes to rewarding consumers for good behavior. For example, if you have no claims, you get, a bonus, right? Your policy or your premium goes down. Why not apply that same type of idea to lending, right? If you're paying your bill on time, you get a better interest rate, right? Or if you have a higher credit score, or smart score, what we call it, you get a better interest rate. So that risk-based pricing actually rewards customers for being a good customer in the bureau. If
Actually,
we look at it that
that's
way,
an important point.
yeah.
But let me just bring Omar into this one, because do banks have that flexibility though to offer proper risk-based pricing? Because I know in some markets, your lending rates might be capped. So in that sense, do you have that much flexibility to actually, give your customer incentives to saying, we like the data you have here. We think you're good credit risk based on the data sets that we have, whatever that may be. We're going to increase your credit limits. We're going to give you a lower credit, or rather a lower interest rate.
I'm sure all banks would love to do it. I'm sure we come back to the information. Do you have enough information to behave this way? But I'm sure most of the bank already do it on other topics, like the type of employees. If we stay on the retail market, for example, it depends on what kind of employers you have. You can get a better rate. It's not, you don't have the same rate if you are an employee at a small company or if you are at an international company. You get a better rate in most of the banks. So I think if you have the proper information and the good information, I think all banks would be glad to have this kind of gesture, because it would enable for them to have more customers. And important to say it's basic, but the most scary thing for banks is the unpaid. Actually, when you lend money and you're not paid at the end. So as a bank, what you do is then try to get as more information or guarantees from your customer before lending money. And we're talking here actually for the unserved people, it's a way of not having any guarantee. You try to lend money without guarantee. So the alternative scoring is also something most of the time very, very risky. I'm talking about, at least for us, the project we have in Burkina. It's a project where it's nano credits, very small credits, but without any guarantee. We're ready to lend money with the scoring on the behavior on wallets, but we're not asking of any guarantee on the customers. And the targets are clearly customers that are non-employees. When you don't ask for any guarantee and you don't have also any kind of information on their employer or anything. So the only information you have is how they behaved in the last year, whether in the bank itself or within the partner, the telco company, on their wallet.
Right. Eunice, I want to bring you into this conversation with a view to the question of social scoring. How do we balance off the need for social scoring or the use of social scoring in some instances versus the demands for data privacy, data confidentiality? At least I know in the Kenyan market, you've got the Data Protection Act that was passed into law in 2019. How do you balance those two off? Can they exist in the same space?
Yeah, I think to take a step back is to just first, within the journey of giving customers trust and then to build on, to start looking at social scores and what else they are doing is, are we upfront with the fact that we are mining this data, and for what is the data being used for? I think majority of the industry is very quick to ask the customer to consent, but then later on, the customer is not sure exactly what they consented to and for what that data will be used for. I mean, a big contentious issue, for example, in Kenya there was mining of social information, like you've saved your mother as mom on your phone, and therefore at the end of the month, or when you default, then your mom is receiving a message being told, remind Dennis to pay his loan, or you will also become culpable. They were okay with the data being mined at the time of registering for the service because they have a need, but then they were not sure for what it's being used for. And now it's being used for a use case that they had not intended. So the clarity for the customer in terms of when we're collecting the data, what is the data being used for? And then moving towards, if the intention is for the customer to benefit from this, do I know what my score is? Can the industry come together and be able to identify a digital scoring approach or fundamental so that Rama knows that their score is X? And how do I grow my score? How do I improve on my score? Looking at the European market out there, everybody knows what their credit score is, and they have visibility to that, whether it's a FICO company-driven score or any other entity that is known in the country. And therefore, I know if my score is good, I'll probably get better rates on from a credit card company, or like Jamila was saying, can the customer start to see the benefit of having a good credit score and not only be afraid of being listed, like that was the key function of that for example, in Kenya. It was being used to scare the customers. Then over time, then people will start to feel more comfortable to share more personal or more information, maybe from social media and from other channels. I'm okay with the visibility on where I live, because, for example, banks ask for a utility to be able to have a physical address of where you're from in terms of enhancing KYC. So I think it's for us to, over and above trust, how can the customer start to see the benefit of this and have clear visibility on what a credit score means and how that can make life better for them from a financial inclusion perspective, access to finance, and how all that can be amalgamated as a central point of information on me as Eunice.
Indeed. I'm going to come to you, Dennis, in just a bit. But Jamila, in practical terms, how do we communicate these ideas to consumers who more often than not are right on the bleeding edge of the credit market? How do we explain? How do we go out there and say, listen, this is the data we're collecting. This is why we need to collect it, and these are the benefits you might have from our collecting this data.
Right. It does take a collaborative effort, right? So not only, of course, as the Bureau, part of our responsibility is to also make that available to each entity that is on the Bureau, and we do that. However, I think it's also a part of all of those that are part of this ecosystem to communicate as well. I think that Eunice said it best, when that information is being collected, at that point, the customer does have a need. They're going to give you that consent. But I'm going to say, have to almost overly communicate that this information is being used in order to allow for you to get more access. And if you will honor your obligations, we have to have the reward systems in place, and people have to experience those award systems, such whether it is the risk-based pricing that Omar talked about. All of these things actually have to be, I'm going to say, really felt by the consumer. And I really don't believe that there has been enough of that, honestly, amongst lenders, whereby they're able to reward their customers. And I'm going to use something else that Eunice said. So if you look in developed countries, the first access to credit is not onerous. It's not, I'm going to say, criminal, if you will, interest rates that we find in Africa. I mean, you can get access to 0%, interest over a period of time, as long as you pay that off within that period of time. Any accrued interest is negated because it's given you, if you will, an incentive to actually pay that credit off on time. Other things is that you get access to, I'm going to go into Dennis's world, small lines of credit when it comes to maybe using telecommunication services. It allows for you to build a history that shows that you are being accountable and you are reliable, so that Omar can trust and have confidence to give you money, because again, a lender's job is to get their money back. And so we just have to find ways to make financial inclusion affordable for the consumer to get into the system, and then let their history be rewarded when they are performing the way that is expected to perform. Until we make that dichotomy all work, it is, again, going to be very expensive for everyone, all of us involved, including our customers. And so we just have to figure that part out and do that part intentionally. when it comes to bringing people into the system, affordable products, good products, relatable products, and then making sure that they get rewarded when they perform in their credit experience.
Indeed. And speaking of over-communicating, I should point out to all of our viewers and our listeners on the webinar that if you've got any questions for panelists, we're getting into the final bit of our conversation, so you can just actually send those down into the Q&A segment since you're watching this on Zoom. Dennis and Omar, I'm going to come to you on this last bit. Especially given your experience working with different regulators, right? Because now it's capital markets, central bankers, data regulators, and we perhaps slightly unfairly, but sometimes you often tend to tell regulators that they're slightly behind, right, in catching up to where the industry is. But what steps do they need to take to essentially make it easier for telecommunications companies or for banks to essentially incorporate alternative credit scoring? Omar, for example, if you're dealing with a central bank and you're bringing in alternative data sets, how then should they consider making room for that when they've been used to dealing with something completely different?
Yeah, it's an important question. I think that up to now, I think central banks are happy to get because all governments in Africa wants a financial institution to lend money to more people. That's key for the government. So when the bank and the financial institutions come with alternative way of scoring, it means that they have the objective to lend money to more and more people. So I think here we should be, there should not be a problem. They should be aligned. I didn't answer before. There was a question on the privacy. I would just add one thing. I think it's clearly the role of the governments to set rules on the privacy, and specifically when we talk about the non-financial data and the kind of data that you can find on social media that has nothing to do with your financial behavior, the kind of thing you pay. This is also the role of the governments to set rules on this, what can be used and what cannot be used, and what, if used, should be deleted after a certain period and not stay with that person, with that individual. So this is something very important to mention. It's not only the financial institution should be actually driven as well by rules that are set by the governments.
And what happens if those rules are not there? For example, in Kenya pre-2019, we didn't exactly have a Data Protection Act. So, prior to that, you're operating sort of in this gray area where what you're doing is not necessarily illegal, but at the same time, there are concerns about how the data is being utilized. So what happens? Do you bring in practices from other markets? Do we adopt practices from, say, GDPR or in the EU?
Well, I'll talk only about ourselves. We're a group that gives a very important ethic is very important for us. So we don't allow ourselves to use any kind of information. I told you we're quite new on that market and using the alternative scoring methodology. For the time being, we focus only on the retail market, only on the information on the behavior on wallets, how the kind of transactions, this is the kind of thing. For SMEs, we rely where we can on credit bureaus that have their own. So we ask information, like say, it's still, for us, at least as the Bank of Africa, we're still in the beginning of using this kind of information. We want to use it more, but with our high standards of ethics. Clearly, we're not ready to cope with any of our values on this. Okay.
Fair enough. Dennis, let's bring you into the conversation. I mean, as you said, you're dealing with 4 different regulators now. So what steps are they taking, at least in your market in Uganda? What steps are they taking to incorporate alternative data sets?
Yeah, so we've been fortunate to have a set of regulators that are quite forward-looking, very accommodative. Some of the aspects that we've put forward to them, highlighting where we see potential challenges now, but also in the future. So it's been a very engaging governance level that we have here in Uganda, and open some ideas, and we've seen that come through. So I just want to sort of highlight some of the challenges that that we, as a market, we have. I think we're very much a what we call a DOC market. So you have two major players in the telco fintech space, which is ourselves and our competitor. We as the market leader also just provide similar services as they do, but to a different scale. They and us have struggled together in this space, especially in this space of providing credit to our market, because customers can just switch between SIM cards depending on where their debt lies, and then it extends to other behavior, such as where they're going to put their next 1,000 shillings that they earn, which SIM card are they, which mobile wallet are they going to put it on. And you find that there's that behavior of customers telling their sources of funds that do not send it on Airtel, send it on MTN, because Airtel, I have a standing loan over there. And that sort of builds into that behavior. It extends the behavior to affect other business verticals, such as your churn, and what they're doing on other networks. So
sorry, just to interrupt briefly. How do you deal with that churn? Because and what you're describing is something that I'm sure Eunice is familiar with. This. It's something that you see as well, in this market. You send money to someone on their mobile line, and they will tell you, no, don't send it to this one because this has debt due to Safaricom on whatever service. Send it to this other line. So it's because you don't have visibility into your competitors' books. Your competitor doesn't have visibility into your books. Then how do you assess credit risk? Because it can very easily turn into this shell game where borrower borrows from Momo MTN and then turns around and pays it back using money borrowed from someone else.
Yeah, just cycling debt between providers. That's, I think, so the point I was trying to make is that has sort of led us to the discussion with the regulator to see how we can sort of have a centralized system where such gaps are addressed, where we have a centralized, platform that will identify if people have certain commitments elsewhere and how that impacts their credit scoring or their issuance of new debt on another provider. So that is one of the developments that we have work in progress to try and centralize our what you'd call our debt management portfolio across the different networks. Very much hand in hand with the competitor, because in this space we're much less competitors, more like partners, because their success is our success, their failure is our failure. So it's important that we approach the problem together, and the regulators have also seen the size of the problem, because that also bleeds into different country matrix, around your debt, around your GDP and all of that. If you start carrying a lot of debt, micro debt. So our regulators have been very open. And I think that's one of the major developments that we're working on, where we have a centralized debt management system across different micro lenders. And that will in some way address the issue.
And I'm going to get to the questions from our audience in just a bit, but how would this, in theory work? Would it be bringing in, say, a company like Yabex to act as a sort of third-party neutral player, where you'd both be feeding that information in and saying, this is what borrower X has taken from us. This is their repayment record, and based on this, therefore, you have a third party who's perhaps under central bank regulatory authority or whatever the case might be, who might essentially act as an independent arbiter of that information between yourself and your competitor.
Yes, it's something similar to that, but I think a little bit more so in the sense that you're going to have all the other elements of that we're speaking about, that the doctor spoke about, that Eunice spoke about, around trust, around customer protection data, around the sanitization of certain aspects of data that has been collected that may not be within the realms of proper or legal application. All of that would be part of that sort of setup on top of all the benefits of making sure that you have one view of a customer's debt obligation across the different providers.
All right, that's certainly going to be an interesting one to follow up on. I want to bring in some of the questions that we've been getting from our audience. Jamil, I'm going to start with you. There was a question that came in here considering AI. And in a year, well, we're what, 2 months in, but still, end of 2022 into early 2023, in a year when things like ChatGPT have been, bringing the conversation around AI and what it can do back into the public domain. The question is this: have we considered using AI to personalize credit score based on their behavior?
Sure. Rama, if you would please, let me just address something that Dennis mentioned, because I think before I go into that, it's important. So Dennis, as you, and this goes really for any country, the bureaus in your respective countries is really that platform that you can trust and share that information with about your customers. And at the point where all competitors are providing that information, it is not transparent or available to each other unless that customer is looking for service, right? At the point the customer comes to your business looking for service, then they are allowed to share information that they have at any of your competitors. So it's a very safe platform for you to share information because that information is only disclosed once the customer wants to do business with you. But it does give you that one view of the customer. And so that's what your bureaus are there for. That's what, the service that we aim to deliver on a daily basis. So I just wanted to put that out there just to make sure that it's clear that that's possibly available in your respective countries. So when it comes to AI, though, artificial intelligence, it is, I'm going to say, a great technology, or should I say framework, that can be used when it comes to trying to understand the behavior of the customer. But in itself, it shouldn't be used alone. I think, when it comes to scoring and things like that, there still needs to be a human element in it, because we talked about the predictors of scoring, or the predictors of information, and some of the things that are predictors, such as relevancy, when it comes to stability, availability of data, AI doesn't necessarily look at that. It just looks at, oh, this information is similar to this information, and it gives you an outcome that you believe is going to be reliable. So say, for example, you might be able to collect shoe sizes, but is the shoe size of someone really going to be predictive of them being good with credit, right? So AI might throw that in there because they see everybody's wearing a size 10. That, so we just have to be careful that artificial intelligence still does require some logic behind it, and that logic still needs to be fed through human subject matter experts that aim to be able to try to meet the goal, which is to minimize risk when it comes to credit, right? To help lenders make confident decisions. So we have to be very careful when we throw out these terms, that we are still putting the right type of science and subject matter expertise behind it.
Indeed, and it also raises more questions around the transparency bit of it, doesn't it? Because if an AI will tell you, we see this correlation between, say, size 10 shoes and better creditworthiness, but it won't tell you why it's seeing
Right.
that correlation.
Right. It won't be, yes, you definitely have to make sure that you're not overlooking things that will be only determined really through logic, right? Through actual logic. So yes.
Absolutely. Eunice, this next question is for you. Do you have examples of alternative data sources in agricultural lending, especially for smallholder farmers?
Yeah, so I think I'll take that question with a step back and give an example of Safaricom at the time when I was there. So they have a product that they're trying to digitize farming from end to end, in terms of how do you allow a farmer to get the right inputs for them to be able to farm and get the produce that's required of the right quality, and ensure then that they have access to market, so that then the cycle is complete. And then the person buying the produce knows that they're buying quality produce, and just that entire cycle. So the the unique nature of this product was that then it got to a point where then farmers are saying, I want to scale. I want to be able to provide BAT with better product from a tobacco perspective, but I don't have access to funds to be able to scale. So then the challenge was for Safaricom to be able to look at these farmers, not just from the mobile data transactions that they have within the ecosystem, but then start to look at where is this farmer based? What size of land do they actually have? And that required partnering with companies that have geo-mapping capabilities. And that opened the minds of everybody up to say, then who can allow us to be able to actually see this farm and be able to say Eunice's capability. I have an acre, but I'm only farming on maybe a quarter because that's the capacity that I have from an input perspective or a labor perspective. We also looked at areas around that area. What does the weather look like in that particular space? And that then allows the person to then be viewed from just more than the financial data that is available to them. Are they members of a SACCO? Do they have multiple outputs with them? Are they farming chicken as well as the tobacco? Are they doing something else that can substitute and therefore say, should this not work out because of maybe weather? What's the other alternative income source that would allow this person to repay the loan but also just go back? So that from an agriculture perspective, it's just looking holistically at the farmer, the space they are in and what it is that they're doing. And that came really in handy, allowing Safaricom to give loans specifically for farming that would then be accessed maybe at a vet, if it's someone in farming. So you give a loan, but that loan is accessible for veterinary services or for input at a particular store in that area through the SACCO that they are in. So that data came quite in handy.
All right, and Omar, this next question is for you. A pair of them actually. One, how will the financially underserved be encouraged to access formal financial services, which are becoming more costly for them? And in context, of course, rates are rising in many of the markets in which we operate in. And two, which companies and geographies are currently the most mature in alternative credit scoring?
Yeah, on the first question, a quick answer. Actually, it should be more affordable for them because, as it was said many times, if the customer doesn't find a good product, he will not take it. And the competition here is not the financial institution. Clearly, for the unserved, is what we call the loan sharks, people that take money at 50% rates. So when we're talking about very small credits for individuals that are unserved, is asking the financial institution to provide loans to those people they don't provide loans to today. Okay, so clearly, at least this is the way we see it. As it's the product should be at a good price, and we know that if it's not at a good price, people will not, the customers will not take it. For the second question on the markets, I think most of the English-speaking countries are more mature than at least the West African countries. West African countries, for one reason. I'm talking about the micro lending. The micro lending in West Africa is limited by a risk interest. The risk is the maximum risk is at 15% per year. It make it at 1.2 per month. To give you an example, this kind of product with micro lending in Nigeria or in Ghana or even I think in Kenya, it's the kind of product you find at 5-6% per month. Very small amount at 5-6%. I think it's too much, 5-6%. But it gives you an idea the difference. In West Africa, you cannot create a product over 1.5% per month. So it makes it really very difficult for any financial institution to launch it. There's only one that launched it up to now. We will probably be the second in Burkina Faso when we launch it, but it's very difficult because 1.5%, you can see the difference with a market when you can have it at 5 or 6%.
Indeed. Riyad, of course, just for the benefit of audience, Riyad, you always our opening experts a little earlier on. He's got some interesting comments that he's made here with regard to financial literacy. Riyad, if you're on the call, can I bring you back in so you can talk about this, give us your input on the question around financial literacy and blacklisting?
Thank you, Rama. Look, I've been in the financial sector for 30 years, so I can see Omar navigating from north to west to central in a different manners because the maturity of the market is not the same in all the places. And I remember when we start, promoting mobile money in Africa, the penetration was low, and because the population was not informed, the utilization of the mobile money was low. And when the communication started going through, and we considered the development of at large scale of a financial literacy program to inform, educate the people about how they can use the mobile money, and then we saw the results. I think same things here. We talk about the data. I think Eunice shared at the beginning of the discussion how the European population, they are all aware about the scoring, about this is, I think, what we need to get. I think data like the job was done for mobile money. I think we need to increase the awareness. We need to build at large scale financial literacy programs so our population will own the importance of the scoring, and they will maintain their scoring system because it's all about us generating data that we need to use for lending or for deposit solution or for other stuff. Responsible finance also, because it's very important to recognize that our players in Africa, they are also adopting all the international standards in terms of responsible finance. I work with more than 100 players in Africa, and I can share that the majority of them, and we have a few players in the call today, the majority of them adopted the international commitment for responsible finance by adopting the responsible finance charts. So I think all of these will help us, I think, by increasing the awareness of our population about all of these data importance. They will better understand the benefits that they can get from it. And I know, for example, in Kenya, when the blacklisting of many customers because of the non-payment become an issue, there was a real campaign of explaining to the population. And I think now we see that the problem not totally resolved, but the NPL now become standard. And we, the World Bank Group and IFC, we are playing. We initiated large programs in North, in East, and West Africa to implement the responsible finance standard, or to help players implement the international responsible finance charts and standards, also to run as much as we can financial literacy programs, mainly in the rural area. So that's my contribution. And if I may say also, Rama, we talk about data and scoring, and I think, many of the speakers spoke about the agriculture. As no data is a data itself. And all what we are addressing, Omar, because he's a banker, he spoke clearly about the importance of having access to information to make a lending decision. And I think the AgTech, for example, now, before we talk about sophistication credit scoring models, by profiling by monitoring the agriculture sectors, they are playing the role in providing relevant and credible data that can help the financial institution to lend safely to the agriculture sector, which is an important sector for our economies and for our people. Thank you.
Yeah, absolutely. I'm going to have to sort of bring the session to a close at the moment. We've covered quite a bit of ground with respect to questions around data protection, data confidentiality, what data works, why it works, what sort of partnerships we do need to build, not just within the industry, but also with our regulators as well. I'd like to extend a huge note of thanks to all my panelists today: Dr. Jamila Aidun, the Senior Managing Director of Credit Registry; Yunus Rogoro Gatama, the Director of Covering Africa at Yabex; Dennis Musingizi, the Acting Chief Product Officer over at MTN Mobile Money in Uganda; and of course, Omar Balefrej from Bank of Africa. And of course, to you, our audience, our viewers, our listeners, wherever you are, thank you very much for your time and your contributions, and of course your questions. We've hopefully covered most of the things that you did send our way. I believe our next webinar should be happening somewhere around April. So if you do have the time for that, please, we encourage you to actually tune in for that. Some more conversations will be taking place between now and June, when the Africa CEO Forum does take place. Hopefully, we'll certainly see you in Abidjan. For now, though, thank you very much. Have a good day.
annual Africa CEO Forum.
L'Africa CEO Forum.
Africa CEO Forum.
Le Davos africain.
Biggest event of its kind on the continent.
Si nous arrivons à faire du beurre et de la pâte de cacao, nous pouvons créer un genre d'OPEP chocolatier.
Really so surprised and excited to see so many people from all over Africa.
This is the place to be if you want to meet all the relevant people that count, that drive Africa's growth.